Welcome to the Ncast Monthly Regulatory Brief. I'm Aileen McDonough, your host and Director of Content Marketing at Ncontracts. In this podcast, our compliance team provides an overview and analysis of the latest regulatory changes for financial institutions, along with info on trends to help you keep up with the rapidly evolving nature of compliance. Let's get started.
Hello, and welcome to another episode of our Ncast Regulatory Brief. Happy New Year from our team here at Ncontracts. Today, we're going to be talking about some of the most important developments on the regulatory front. And to do so, I have Katie Ferrell, our regulatory compliance expert, and Cheryl Grizzard, our regulatory compliance counsel, joining me for this Ncast. And as a reminder, I am Stephanie Lyon, Vice President of Compliance, and we are thrilled to have you here with us today. We're going to start with issues affecting everyone in the industry. We're then going to move on to issues affecting our depository institutions, banks and credit unions, for example, and we're going to end with our mortgage companies. First, we're going to go ahead and talk about lending. Lending has been a hot topic during COVID this entire time, and I think it's only fitting to talk about things that change every single year. So, Katie, take us away.
Yes. Hello, everyone. Happy New Year. The Federal Housing Finance Authority officially announced the conforming loan limits for mortgages to be acquired by Fannie Mae and Freddie Mac in 2022. The most well-known Freddie and Fannie guideline is the size of the loan, and any mortgage that exceeds the conforming loan limit is known in the industry as a jumbo loan. So for 2022, in most of the United States, the conforming loan limit for one-unit properties is $647,200. which is an increase of nearly $100,000 from 2021. In some high-cost markets, such as New York City, DC, and San Francisco, the conforming loan limit each year is set at a ceiling of 150% of that limit I just mentioned. So in the case of 2022, that limit is $970,800. So we are quickly approaching the $1 million mark for conforming loan limits for high-cost markets. These limits are adjusted annually based on the average U.S. home price, which even during the pandemic increased nearly 18% on average between October 2020 and October 21. And just to give you a historical perspective, the conforming loan limit was $417,000 from 2006 to 2016. So we've seen almost a 50% increase in U.S. home prices over the past 6 years. And in even further walk down memory lane, the original loan limit was established in 1980 at nearly $94,000. So time really flies, and the average U.S. home has really increased over the last 40 years. Speaking of Freddie Mac, they have said no to crypto. Due to the high level of uncertainty associated with cryptocurrency, Freddie Mac published a bulletin this month to its sellers that essentially stated that borrowers cannot use cryptocurrency as basis for income or basis to repay a loan. On the flip side, if crypto secures a debt, it must be included in the debt-to-income ratio. And finally, the bulletin stated that if cryptocurrency will be used for a mortgage closing, it must be transferred into U.S. dollars before the transaction closes, and seasoning requirements may apply. We will, of course, continue to track all guidance related to cryptocurrency, but currently it generally is still not a universally accepted eligible source of funds during the underwriting process for Freddie Mac mortgages.
Katie, thank you so much for that update. You did mention the high-cost market of New York, and I know we do have some news from New York as well, right, Cheryl?
Yes, New York's Governor Kathy Hochul signed legislation that will allow reverse mortgages on co-ops owned by seniors 62 years or older. This new law substantially expands the market for reverse mortgages in New York. It doesn't apply to federal home equity conversion mortgages insured by HUD or FHA, as those loans will still be required to only apply to loans secured by real property. But lenders that offer private label mortgages will be able to provide these products to co-op owners. The new law will be subject to additional legislation and regulations, and right now it's slated to take effect on May 30th of 2022.
Thank you, Cheryl. All right, we're going to move on to beneficial ownership information, and that is FinCEN. Just to remind you, how did we get back to talking about beneficial ownership since a couple of years ago? There was a law passed earlier this year that is going to amend how we do beneficial ownership registry and customer due diligence. So financial institutions don't have to be the repository of all of this information, which was really never supposed to be the intention or the intent for financial institutions. So what we see now is the first proposed rule out of a set of proposed rules we're going to need to modify customer due diligence requirements. And this specific proposed rule is all about who needs to file beneficial ownership information, what kind of information they need to file, and when they need to file that information. So when it comes to financial institutions, it doesn't have a ton of impact on you yet. We do expect 2 additional proposed rules later next year, probably, regarding the modification of the customer due diligence rule, of course, so that you don't have to be collecting this beneficial ownership information directly from your non-natural person customers. And then the second regulation that we expect will have to enforce how and who can access this registry information in the first place, as well as what kind of safeguards we're going to see to protect that information. So those are really important developments. We're going to keep you updated with beneficial ownership changes as we see them. You have until February to comment on this proposed rule. Again, not a ton of impact on you. The next thing we want to talk about regarding beneficial ownership, but in this case, FFIEC BSA AML examination manual updates. That's a whole mouthful right there. But this is tremendous guidance that is here for financial institutions to understand the examination requirements or what to expect when your examiners come in and look for BSA AML compliance. This handbook was just modified. It's usually modified a couple of times per year. The modifications were not substantive. The modifications are all about adding a new or introduction about customers. And it reminds examiners that not one type of customer is truly higher or high risk. So you have to really consider your customer due diligence, your capabilities of detecting suspicious activity. And that's what's going to tell you if you are appropriately mitigating the risk for money laundering or terrorist financing. So just because you're choosing to serve, let's say, cannabis businesses, or you're choosing to serve any type of ATM operator, that doesn't mean your institution is automatically higher risk. It just means you need to have the appropriate safeguards to prevent the bad actors or the illicit cash from flowing through your institution. So that's the update on that manual. And again, phenomenal guidance. If you are involved in BSA AML compliance at your institution, don't forget to check it out. We're going to go ahead and move on to something that is on everyone's mind, and that is, of course, vaccine information. We can't have an Ncast right now during COVID without talking about it. So what is the latest on vaccine updates, Cheryl?
A Georgia district court issued a preliminary nationwide injunction blocking the enforcement of the federal contractor vaccine mandate. And as a quick recap, the mandate would have required government contractors and subcontractors to be vaccinated. This could affect financial institutions that conduct business with the federal government or that have branches on military bases or other federal property. The nationwide stay means that for the time being, the government's vaccine mandate is unenforceable, and contractors that do not need to meet the original January 18th deadline. But if employers want to, they can go ahead and be proactive and implement vaccine policies as long as they comply with current state law. Now, moving on to OSHA's vaccine mandate, the Sixth Circuit Court of Appeals dissolved a stay previously in place that was placed on OSHA's Emergency Temporary Standard, or ETS. This means employers with 100 or more employees must require their employees are vaccinated against COVID-19, or they are required to wear face coverings and undergo weekly COVID testing. OSHA announced that it will not issue citations for noncompliance with its standards before January 10th of next year, and they will not issue citations for noncompliance with the testing requirements before February 9th, as long as employers are exercising reasonable good faith efforts to come into compliance with the standards. Of course, we'll continue providing you any additional updates concerning the vaccine mandates.
Perfect. Thank you so much, Cheryl. And we're going to move on to a completely different regulator. We're going to go ahead and talk about the lovely CFPB. And Kate is going to go ahead and lead what's going on with the CFPB, Katie.
CFPB has been very busy all year, and December was no different. They once again exercised their authority under the Dodd-Frank Act, and they ordered 5 of the most popular buy now, pay later companies to provide a plethora of additional information about buy now, pay later credit. Our listeners and we are probably very familiar with seeing offers from companies like Affirm, PayPal, Klarna for products that range from electronics, exercise equipment, vacation bookings, and really all in between. Being deemed the modern day layaway plan, these offers usually allow a consumer to pay a fee anywhere between 3 and 6% of the purchase price, with a exchange of a convenience to split up the remaining balance into smaller installments. Unlike the layaway section I remember as a kid that was all the way in the back of the store, most of these transactions are conducted via app or online instantly. Typically, the number of installments for these plans are 4 or less, and usually they offer a 0% interest rate, which sounds like a pretty good deal, right? Well, however, the watchdog of the consumer financial marketplace has concerns. Buy now, pay later credit is dominating consumer loans, and it's been reported that 1/3 of shoppers recently have used this type of credit plan. The CFPB has seen dramatic spikes in the use of buy now, pay later credit during the COVID pandemic and during the recent holiday season, and is concerned that the ease of use of this type of credit could lead to impulsive buying and what we all know as buyer's remorse. So to understand this type of credit better, the CFPB is requesting detailed information to get more information about business models and metrics, including credit reporting, which was just mentioned in the news last week that Equifax stated they will begin including buy now, pay later programs in payment histories as early as February. So those of you who are utilizing credit bureaus, which is all of us, for lending may see some of that activity as early as February of 2022. They're also interested in the disclosures that are being used for these credit plans. And I thought an interesting component is they're interested in the reasoning behind targeting certain demographics for these credit plans, as well as how they are sharing the data they are harvesting from consumers. In a statement, the CFPB expresses concerns that if a consumer has multiple purchases on multiple schedules with multiple companies, it may be very difficult to track when those payments are scheduled. The CFPB also in December published a blog that was addressed to consumers, warning them of the risks associated with this type of credit. Now, statements from all of the companies, all the 5 companies that are under this order have been very vocal that they are willing to be transparent and provide all of the information requested. So how does this affect all of us in the industry? Well, again, like I said, the credit bureau reporting could be one element. You may be offering very similar plans, but I think more importantly, it should put all of us on notice that a more aggressive, more responsive CFPB is back. And I don't believe 2022 is going to be any different. So stay tuned and we'll look for the CFPB's findings report on buy now, pay later companies.
Yes, and we're going to stay with the CFPB, but we're going to move on to issues affecting depository institutions. As Katie mentioned, the CFPB is just busy this season, and they're gifting us another really interesting study, and this one is about overdraft protection programs, or just overdraft programs. What they found is that even though during COVID, there were a lot of financial institutions that waived overdraft fees for their customers because we were in the middle of a pandemic, there's still a tremendous rise in reliance on the profit center for these types of programs. So they saw that some of the largest banks in the United States, they have about 44% of the entire overdraft fee market. And unfortunately, what the CFPB has found through studies and other types of methods is these types of overdraft programs tend to disproportionately affect our lower income individuals, those people who are reliant upon helping get through one paycheck or helping to make one payment when they don't have the cash in their account. They're the ones that are consistently in the cycle of overdrawing their account, and they make up about 80% of the folks that do have overdraft fees in their accounts. So because this affects lower income individuals, of course, the CFPB is not the biggest fan of these types of programs or the amount of reliance by financial institutions on these type of non-interest income programs. So what they're trying to tell financial institutions is they're going to be watching out to make sure you're appropriately complying with overdraft protection requirements. So make sure you're reviewing your regulatory requirements under Regulation E. Make sure you're reviewing the overdraft guidance that has been issued many, many years ago by most of the regulators. They signed on to this guidance. Look at your risk assessment regarding overdraft programs and look to see if you have an increased risk for regulatory violations, because overdrafts have been in the headlines for a very, very long time. Not that long ago, we had class action lawsuits regarding overdraft programs. We've had multi-million-dollar penalties issued by the CFPB and other regulators on overdrafts because they found that financial institutions have been ordering transactions to maximize these fees. They have been utilizing deceptive or abusive acts or practices to opt in consumers without truly explaining how they're going to get an overdraft fee. Or they've been even saying that overdraft protection programs are quote unquote free, which you know that word is the regulator's favorite word when you use it for checking accounts. So you need to be watching out for your increased risk in that space. You also need to be looking and testing your own program and vendors to make sure that if you are allowing anyone to contact consumers on behalf of your institution to get them to opt in to overdraft protection programs, that they're not engaging in the deceptive or abusive acts and practices that I have mentioned, because that is another thing that our regulator is looking out for. And the CFPB is not alone in their interest of overdrafts. So if you're a smaller community-sized bank or credit union and you're thinking, yes, that doesn't affect me, actually, the OCC and NCUA have both made remarks either during prepared remarks for conferences or during interagency webinars that they will too be watching out for overdraft protection violations and issues affecting consumers. So this is the time to be taking a look at your programs. And the other thing I want to mention about overdraft programs is some of the larger banks like Capital One and PNC have already taken proactive steps to mitigate their risk and be quote unquote consumer friendly. How are they doing this? Well, Capital One completely removed overdraft fees from their checking accounts, which was a tremendously large move by such an incredibly large bank. And PNC said that they were going to completely revamp their overdraft program to minimize these types of fees by giving you fee waivers or giving you more time to cure overdraft violations so that you don't incur this fee. Those are the types of things that smaller community-sized banks and credit unions can and should probably also be thinking about doing to improve the marketplace and to improve the financial literacy and capability of your consumers. So that's what we have regarding overdrafts. We're going to move on to issues affecting just our banks, and we're going to go ahead and kick it off with an update on community reinvestment, Katie.
All right. Well, I don't know if I would necessarily consider the December 14th issuance of this final rule a surprise, but the effective date is virtually now, depending on when you are tuning into this Ncast. I think we can all agree it has been a roller coaster ride these past few years for our OCC regulated friends who are responsible for compliance with the Community Reinvestment Act. Earlier this fall, we were put on high alert that the new CRA provisions that were just issued in 2020 could be stopped dead in their tracks before they really got going. And as suspected, the OCC did officially rescind the 2020 CRA rule this month and replaced it with a final rule that is substantively identical to the 1995 rules adopted by the other agencies years ago. In short, the definitions, performance standards, and all related data requirements all revert back to those in place prior to the 2020 rule. And most provisions will take place January 1st, 2022. So depending on when you're tuning in, that could be a few days ago. According to the OCC, this action facilitates their alignment with the other agencies, the Federal Reserve and the FDIC. And according to the OCC, it's intended to limit the CRA burden on banks in the communities and the low to moderate income neighborhoods that they serve. But what do most of our OCC banks really want to know? They want to know, how does this impact them if they were already in process of implementing certain provisions of the June 2020 rule? Well, again, according to the OCC, transitioning back to the 1995 rules should have a limited burden, since the majority of the June 2020 rules provisions had not yet been implemented. However, if you have questions or concerns, I highly encourage you to reach out to your OCC regulator, specifically if your 2022 strategic plan was approved under the 2020 CRA rule, or if your bank was relying on certain qualifying activities outside your assessment area for performance consideration. I also want to remind our listeners that back in September, the OCC did issue frequently asked questions that addressed concerns related to the transition period for tracking activities that formerly qualified under the 2020 rule, but will not under the reinstatement of the 1995 rules. Again, this final rule carries a compliance date of January 1st, with the exception of certain provisions such as public file and notice requirements that have a compliance date of April 1st, 2022. And just on a personal note, I wish you all well as you navigate the transition and rescission of this rule.
Yeah, talk about a poorly transitioned rule-making process that has been really defective and disruptive to our OCC regulated banks. So hopefully we'll have better insights for them soon. All right, we're going to move on to something that I have never seen before in my career in financial services, and that is such a public outcry between two very visible regulators. And I'm talking about the dramatic fighting between the FDIC and the CFPB. What am I talking about? Well, you may have seen some op-eds in newspapers. You may have seen some announcements by the CFPB that they were going to be looking into bank mergers, followed by a statement from the chairwoman of the FDIC stating that not such thing was going to actually take place. So what happened is actually there is a board that meets regularly to decide the agenda of the things that regulators are going to consider when it comes to rulemaking. On that board sits the chairwoman of the FDIC, currently McWilliams. We have our director of the CFPB, Chopra. We have director of the FDIC, Grunberg. We have a vice chair. Currently, that seat is empty. And finally, we have the acting controller of the OCC, Michael Sue. So those folks decide to vote on what they want to be chatting about, what they want to be setting on their agenda. And something that is very important for the CFPB at the moment is talking about bank mergers, because for the past 15 years, they haven't seen any bank mergers being declined by the regulators. And they are thinking that it's time for the consolidating industry to really take a hard look at itself and decide if this is actually helpful for the financial sector and, of course, for the consumer marketplace. FDIC chairwoman, who is the only Republican nominee currently sitting on the board, completely disagrees that bank mergers is anything we need to be currently talking about. And 2 out of the 5 members chose to vote on actually talking about it. And this was Director Grunberg from the FDIC, as well as Rohit Chopra from the CFPB. And they said they have a majority at that point, and they can go ahead and set the agenda. If you can count 2 minus 5 is definitely not a majority yet. But when you have an empty seat, you could make, I guess, some kind of argument that that is some kind of at least half and half majority at that point. And of course, the FDIC is very upset about it. And we have seen Congress people weigh in on all of this, which again is not that normal for Congress people to be talking about what the regulators are doing or not doing, but it's very partisan at the moment. Everyone on the Republican side is saying that Rohit Chopra and Director Grunberg overstepped everyone on the Democratic side is saying that bank mergers is something important that we should be talking about. But ultimately, whether we talk about it or not talk about it, it's a pretty divisive time, both in Congress and at the regulators area, because we are allowing politics to bleed into the nominations of these people that are leading the agencies. So what can we take out of this, or what can we take away from this infighting that's happening very publicly for everyone to see? Well, a couple of things. One, there is a potential that there will be litigation, and that Rohit Chopra and also Mr. Director Grunberg will decide to go ahead and pursue the agenda item and go to court. The court doesn't have to take this case if they don't want to. The second thing that could happen is the chairwoman, McWilliams, could decide to block any additional Democratic agenda items or make it very difficult for the 3 out of 5 members to bring anything into the agenda committee, because again, the statute's not clear on who can and can't set the agenda, if it's just the chairwoman or if it's the majority of the board. So we'll be watching out for what else happens. But again, this is not anything that leaves our industry looking good, feeling good, or being able to collaboratively work together. We're going to go ahead and wrap up with our banks and move on to issues affecting credit unions. And in this case, we have a little bit about third parties and digital asset guidance. Cheryl, take it away.
NCUA issued a letter to federally insured credit unions to provide clarity about the existing authority that credit unions have to establish third-party relationships with digital providers of asset services. These providers are allowed to provide certain services to members of the credit unions outside of the credit union involvement. This includes services that will allow the members to buy, sell, and hold uninsured digital assets with these providers. The relationships with the third parties offering these services and technologies will be evaluated by NCUA in the same way other third-party relationships are evaluated. They'll be looking at things like risk measurements and control practices that are in place for these arrangements. The authority for federally insured state chartered credit unions to establish these type of relationships will depend on applicable state laws. But NCUA has acknowledged that further guidance and questions may need to be addressed. So they may continue to issue legislation about this and additional guidance to credit unions.
Thank you so much, Cheryl. And we're going to go ahead with another piece of important information regarding mortgage servicing and NCUA. Katie, what's going on with mortgage servicing?
NCUA did issue a final rule that beginning April 1st, 2022, federal credit unions may purchase mortgage servicing assets from other federally insured credit unions, or MSAs for short, and also known as mortgage servicing rights prior to the issuance of this rule. And just as a reminder, mortgage servicing rights are a contractual obligation to perform mortgage servicing and the right to receive compensation for those services. Historically, MSAs have been a prohibited investment for federal credit unions, but this final rule does establish some parameters around this type of investment. Essentially, federal credit unions with a CAMEL or CAMELS rating of 1 or 2, as well as a management component rating of 1 or 2, may purchase the MSAs of loans from other federally insured credit unions that they are also empowered to grant, that are made in accordance with written, approved policies and procedures, and that their board of directors has approved in advance of the purchase. As we know, mortgage servicing innately carries various risks. So to be responsible and successful, investors of MSAs really need to understand the complexities in determining the value of MSAs, as well as the impact these investments can have on their compliance management systems, internal controls, and overall risk management. April 1st is right around the corner. So if you have not already, I encourage you to begin the conversations with your board and appropriate personnel now around the benefit of purchasing MSAs to your mortgage loan servicing operations. I also encourage you to evaluate any risks associated with the purchase of MSAs as well as any necessary updated written board policies and procedures, and any other general resources or training necessary to help you responsibly participate in this newly allowed investment.
Thank you, Katie. And you heard her. Start early, start planning. That's always the best route. All right, we're going to go ahead and move on to mortgage companies. And this is a topic actually that we covered last month for banks and credit unions regarding customer information security programs and breach notifications. And now Cheryl is going to talk to us about this specific area, but for mortgage companies.
FTC issued a request for public comment on its proposal to amend its safeguards rule. And basically what the rule would require is that covered financial institutions would be required to report to the FTC any security event where the financial institution has determined there has been a misuse in customer information that involves at least 1,000 consumers. Now, this information would need to be reported to the FTC within 30 days from the discovery of this security event. Now, what's significant here is the term covered financial institutions. They define this term very loosely. It does include non-federally insured credit unions, mortgage brokers, mortgage bankers. So it's pretty loosely defined here in the proposal. If your institution is covered under this proposal you wish to comment, you can do so by February 7th of 2022. FTC also issued a final rule pertaining to the information security programs. The final rule contains 5 major modifications to its existing safeguard rule, and it includes things like additional guidance on how institutions can develop and implement specific aspects of an information security program. It also adds provisions that are designed to improve the accountability for institutions in security programs, such as requiring periodic reporting to the board or other governing bodies. It exempts certain institutions who may collect less customer information from certain requirements. As I said before, it explains the definition of financial institutions, and it defines other terms that they have incorporated from its privacy rule, which governs the protection of a consumer's non-personal information. Now, the final rule is effective on January 10th of 2022, but certain provisions won't be effective until December 9th of next year. So just stay on the lookout for additional guidance coming from the FTC on these rules.
Well, that does it for us. If you have any questions on any of the topics we covered today, or you want to see additional regulatory changes, news, and guidance, don't forget to check out your Ncomply. On behalf of Katie, Cheryl, and myself, we hope you had the most phenomenal Happy New Year and that your 2022 is off to a phenomenal start. We will hopefully see you next month, and we hope to deliver more important information then. Take care.
That wraps up this month's Ncast Regulatory Brief, talking with our compliance experts about the latest regulatory changes you need to be aware of. If you liked what you heard, please leave us a review. And if you're not subscribed yet, we invite you to do so on your favorite podcast platform. Thanks for listening.